America lost 23,000 jobs in July. Wall Street celebrated. Within hours, the S&P 500 hit a brand new all-time high. The country was losing jobs. The stock market was setting records. And for workers, fewer jobs are not good news. It means fewer opportunities, less leverage to negotiate higher pay, and more competition for the jobs that are still available. So why did Wall Street look at the exact same jobs report and come away with a completely different reaction? Because investors weren't just looking at jobs, they were looking at interest rates. Before this report, one of the market's biggest concerns was that the U.S. economy might stay too hot for too long. If companies kept hiring aggressively, wages could keep rising. If wage pressure stayed high, inflation could become harder to bring down. And if inflation refused to cooperate, the Federal Reserve would have less room to ease up on interest rates. That's a problem for stocks. Higher interest rates make money more expensive, they raise borrowing costs for companies, and they reduce what future corporate profits are worth in today's dollars. That pressure hits growth companies especially hard, particularly big tech companies, and because those companies make up such a huge share of the major U.S. stock indexes, changes in interest rate expectations can move the entire market. That's why this weak jobs report changed the calculation. Hiring cools, pressure on the Fed eases, pressure on bond yields eases, and lower yield pressure gives stock valuations more room to rise. As markets digested the report, the 10-year Treasury yield moved to around 4.64%, and that's where you get one of the strangest rules on Wall Street. Sometimes bad economic news can become good news for stocks, but only if that bad news lowers the expected price of money. But there's a very important catch. Wall Street does not want the economy to collapse. If this jobs report were telling investors that the U.S. was heading into a severe recession, falling interest rates wouldn't be enough to save stocks, because a recession creates a very different chain reaction. Household income falls, consumers spend less, companies bring in less revenue, and eventually, corporate profits fall. That's what the stock market really fears. So what investors want is a very narrow middle ground. They want hiring to be weak enough to reduce pressure on interest rates, but not so weak that it threatens corporate profits. Wall Street wants cooling. It does not want a crash. And once you understand that, you can understand why people living in the exact same economy can feel like they're living in completely different worlds. A lot of companies right now aren't panicking. They're not firing huge numbers of workers. But they're not hiring aggressively either. You could call it a slow hire, slow fire economy. Instead of announcing massive layoffs, companies can simply shrink through attrition. Someone leaves? Maybe they don't replace that person. A team loses a worker? Maybe the remaining employees are asked to do more. And in some cases, automation or AI tools can handle work that might have required another employee in the past. Now, AI is not the whole story. Financing costs are still high. Companies are still cautious. Trade, energy costs, demographic changes, and shifts in the labor supply are all playing a role. But the bigger trend is pretty simple. A company can potentially keep producing more and protect its profits without adding nearly as many workers as it used to. From an investor's perspective, that's called efficiency. From the perspective of someone sending out resume after resume, it can feel brutal. But there's an important distinction here. The U.S. is not suddenly experiencing an employment collapse like 2008. Some parts of the private sector are still adding jobs. Healthcare, construction, and manufacturing are still showing employment growth. Overall layoffs also remain relatively low. And part of July's job decline came from weakness in local government education employment, so collapse probably isn't the best word for what's happening. Freeze may be closer. Companies are still trying to hold on to the workers they already have. What they're cutting back on is new hiring, and that creates a very strange economy. If you already have a stable job, things may still feel fairly normal. If you own stocks, the economy might actually look pretty good. If your company is still profitable, the business environment may seem healthy. But if you just graduated, if you're trying to change careers, if you're hoping to switch jobs for a raise, or if you were recently laid off and you're trying to get back into the workforce, the same economy can feel like every door is slowly closing, and that's the real divide behind this stock market rally. Financial markets are pricing interest rates and corporate profits. Workers are dealing with job openings, bargaining power, and paychecks. Right now, those two scoreboards are moving in very different directions, which brings us to the real question: how long can that last? Because if hiring keeps getting worse, eventually the damage won't stay confined to the labor market. Slower income growth can weaken consumer spending. Weaker consumer spending can hurt company revenue, and once corporate profits start falling, the same economic weakness that helped stocks rise can suddenly become the reason investors start selling. That's when the whole bad news is good news logic breaks down. So when the next jobs report comes out, Don't focus only on the big headline number. Watch what happens underneath it. Is hiring still getting worse, or is it starting to stabilize? Is labor force participation still falling? And just as important, watch inflation, because weaker employment only becomes a real interest rate positive if inflation gives the Federal Reserve room to ease policy. If inflation stays stubbornly high, then a weaker job market may not give stocks much help at all. And if employment deteriorates too quickly, lower interest rates stop looking like a gift. They start looking like emergency treatment. That's why the July report matters. It may be showing us a different kind of economy, one where U.S. output can keep growing, corporate profits can keep growing, stock prices can keep rising, and at the same time, the economy can stop creating as many opportunities for workers as it once did. And that may be the most uncomfortable part of this entire story. A rising stock market and a weakening job market aren't necessarily contradictions, because they're not measuring the same thing. Wall Street is asking, if hiring weakens, what does that do to interest rates and corporate profits? Workers are asking a much simpler question. When I send out my next application, is there still a better job waiting for me on the other side? Right now, those two questions are getting very different answers. And if the U.S. economy keeps growing while hiring remains weak, then the biggest question may no longer be, how much more can America produce? It may be this: who is all that growth actually for?